Hey guys, Akil here. Welcome back to another episode of the Trading Coach Podcast. Today is another video episode, so if you want to see the visuals, and we are going to hop on the charts for a little bit, make sure you head over to a podcasting app that shows the video version. I know Spotify does, and I'll put this video on YouTube as well. For you guys watching on YouTube, this is the Trading Coach Podcast. I put these out 3 days a week. The visual ones you get to see here on YouTube. But if you want to hear the audio ones as well, just head over to your favorite podcasting app and check them out. Today, we're going to talk a little bit about Dow theories. I'm going to make it as dummy-proof as possible. And this stems from a conversation that we were having the other day in our Monday Q&A session. Every Monday on our Tier 1 trading platform, we have a closed door Q&A session where we bring the traders in, they ask questions, we put together lessons. And in this specific session, we were talking a little bit about complex pullbacks, meaning multiple leg pullbacks and how to determine whether the trend is still intact, the overall trend that is, or if we have violated it. And we started talking about Wyckoff cycles in Dow theory. And it stems some questions about the other part of Dow theory, because although part of it is charting and how the market moves, it's much broader than that, as there are 6 principles, and we're going to run through all of them today and tell you what they are and why they are important. So what is the point of these 6 principles? These 6 principles are essentially theories that were created to explain and interpret how the financial markets move. They were created by Charles Dow, who, if you ever heard of the Dow Jones, yeah, he's that guy, him and a few other friends, I think 2 other friends. And they created this index, which is like a bundle of different stocks, taking all of your favorite things and putting it into the same little capsule and trading it as one individual entity. They created this index in order to have a more reliable way of understanding the economic conditions. You see, their theory was this: if the economic conditions were positive, then this index should be positive. And if this index is positive, it would make it a lot easier to identify individual stocks to trade or invest. So I'll give you an example, because this was my method during my early investment days, right? When I first started investing, I did not have a lot of money. I was fresh out of college. I was in grad school. I had a couple $1,000s to my name, and I said, let's throw them into the financial markets, right? This was actually a pretty decent time. It was 2008 going into 2009. So it was coming off kind of like the highs of the stock market right into that recession thing. So I had the opportunity to see a lot of stocks that were previously priced at their highs, I guess you can say, and I got to see them at a discounted price. And if you know anything about the stock market, crashes happen, but they don't last forever. Things rebound, and when those big crashes happen, while everyone else runs off and panics, for the smart investor and trader, it offers massive opportunities. We did this during COVID as well. But I'll give you an example, right? So as the market started to rebound and we started seeing more positivity in the market, we started seeing different sectors start to flourish. So for example, the tech sector is something that historically flourishes when people are positive and feeling good about themselves. So I paid attention to the overall markets. I paid attention to the tech sector, which was kind of going all in this stream of positivity. And within that tech sector, I decided to pick out tech stocks that were cheap enough for me to have exposure to. And one of these tech stocks, you probably heard of this name before, was a company, newish company called NVIDIA. I think they were less than like 10 years public. And I bought them up for like 30 cents, right? Amazing. If you look at a chart right now, you'll see just how amazing that is. But the point was, everything was flowing in the same direction, right? The economic condition was getting better. The stock markets, the indexes were getting better. Within those indexes, the indices, the sectors were getting better. And then instead of trying to buy the big expensive things, I wasn't working with a lot of money, I knew that, hey, I can pretty much find almost any tech stock. And because this sector was positive, it would go along for the ride with them. And that's exactly what happened. So again, using the bigger picture, the bigger flow to kind of pick the small fish. Now, not all the elements of Dow theory are as relevant today as they were back in 1896 when it was first invented. But many of those principles still are. And in general, my philosophy is that, and this is both as a trader and a coach, is that the more that you can understand the market, the more knowledgeable you'll be as a trader. The more knowledgeable you are as a trader, the more you can increase your edge. The more you can increase your edge, the more money you can make. And ultimately, that is the name of the game. How can we make as much money as possible? while keeping our risk in check. Always remember that part. That's the part that the scammers don't tell you. So understanding this stuff has been helpful for me, and I think it will be helpful for you as well. So let's break down these 6 principles. Principle number 1 is that the market discounts everything. And basically what this means is that there is no secret information, right? Whatever the market is showing you, it is showing you based off all of the information that is out there in the world. There are no secrets. So here's something I like to say, right? As far as technical analysis goes. The price chart is nothing more than a visual representation of all of the market's participants and all of the actions that they have taken. These actions could be taken due to fundamental reasons. They could be taken due to technical reasons. They could be taken due to fear, due to greed, due to whatever. It doesn't matter why people are doing what they are doing. The fact is, when you look at a quote, when you look at a chart, it represents all the stuff that all of us have done, the smart stuff, the dumb stuff, and everything in between. There are no secrets. And this is something that gets a lot of traders into trouble, meaning that they get too caught up over understanding why stuff happened. Now, I don't want to say it's completely irrelevant. As someone that didn't come up with a formal economic background, I didn't learn a lot about what made the market move. So it was very beneficial for me to see big moves in the market and be like, hey, Friday, 8:30, why did that happen? Oh, non-farms. This is a regular thing, okay? Right? It's cool to have that knowledge. It can, again, increase your ability to be involved in the market, increase your edge that way. It can also increase your ability to know when to avoid being in the market, and that in its own way can increase your edge. But sometimes we get too caught up over understanding or trying to understand every single detail of why the market moved. And sometimes there just isn't an answer. How come price broke that key level of support that was supposed to hold? Because that's what the market did, right? The market does whatever the it wants whenever it wants to do it, right? That's another code of trading that you need to accept. So it's okay to be curious. It's okay to learn, especially when fundamental releases are out. But understand that we're never going to know or understand every single detail or every single reason of why the market moves. We just need to focus our energy on, okay, now that I see it has done this, what do I predict is going to happen next? Principle number 2 is understanding that there are 3 primary types of trends. So this is basically understanding how the market moves. There are extensions where price is extending, there are pullbacks where price is retracing, and there is consolidation where price is kind of just doing nothing. I think Dow called it noise. If you guys have ever been to one of our workshops, we've done many of lessons on this. If you head over to the YouTube channel and just, I think, YouTube search under my channel, how price moves or something like that. There's plenty of lessons teaching you this, but for a very remedial way of thinking about it, if you're looking at a price chart and price action is going from bottom left to top right, as you can see on your screen right here for you guys watching the video edition, that is going to be an uptrend. If price is going from top left to bottom right, that is going to be a downtrend. If price is kind of just going straight across the middle, that is going to be consolidation. And the importance of this is understanding that these 3 primary trends work in what's called fractals. So fractals are like things within things within things within things. Like think about it like a snowflake, how a snowflake has a very unique pattern, but if you zoom in on it, there's a pattern within the pattern. If you zoom in on it, there's patterns within the pattern, right? Boom, right? So trends are the same way. There can be bullish trends, uptrends, and then you have pullbacks within those bullish trends, which are completely natural, by the way, that on a lower time frame or a lower time period will look like bearish trends in their own right. But that bearish trend is only a pullback in the bigger trend, right? And that's how people get confusing. I won't make this a whole podcast on multiple time frame analysis, but it's very important if you're going to use multiple time frame analysis, which I think you should, you need to understand what you're using each time frame for. That way you can keep perspective. If not, you're going to be like Inception and you're not going to know what's reality and what's not reality. And you're going to end up watching a top spin forever, not knowing if it ever toppled over. Do you know? Does anyone know? Like, I spent my whole life trying to figure this out. I've watched it so many times and I still don't know. If you know, please let me know. This is the thing that is going to haunt me until I'm on my deathbed, right? Now, why is understanding the markets important? Well, because it's probably just the most important thing that it comes to our trading, right? We need to understand what the market conditions are, right? If we are in a heavily bullish market, we don't necessarily want to be sellers, obviously, unless we're at a specific point where we're interested in selling, and vice versa. So understanding how to read a price chart, understanding how to recognize if we are bullish, if we are bearish, if we are in a short-term pullback, if we've had a violation of trend, those are the key elements that go into setting up our trade. Something I teach traders on the Tier 1 trading platform is a 4-step process called IPDE: identify, predict, decide, execute, where it's really a routine, a ritual that we use to ensure that we're on the right side of the market and we don't get all confused and weird and stuff each time we do analysis. So we start by identifying what is the market doing, what has the market done, meaning are we bullish, are we bearish, are we in consolidation, where are we at relative to structure or other important levels. Based on what we identify, we can then predict, oh, based on what I saw, I think we're likely to continue bullish, or I think we're likely to get to an exhaustion point and have a little pullback and go bearish, or we're likely to break out of consolidation. After we form that prediction, we can then decide how we want to attack the market. Based on us being bullish and us recently having this pullback, I think I can enter at the low of this pullback. That way I can hop on the next extension up, right? You see it all flow. And then E is execute the trade, right? Pull the trigger. I don't know, how do you do triggers with finger guns? That's pew pew. That's weird. Anyway, come on, Akil, focus. So that sets ourselves up in a way that we are consistent every time we read a price chart. And my philosophy on things are consistent analysis plus consistent execution equal consistent results. Meaning if you can analyze the price chart the same way each time using the same routine, and you can actually take the trades with consistency, meaning you don't have FOMO and enter too early, or you're fearful when you don't enter at all, then you should get the results that your back testing results say you should get. And that's what professional trading looks like. This also helps from a mental side, right? Let's say you are someone that is a trend trader, meaning that you're someone that is a long-term trader, a long-term investor, and you hop on the trend. I hope you understand, it's maybe a news flash, right, for you. I hope you understand things don't go up forever. Right? The markets ebb and flow. They breathe in and then they breathe out, right? So price will go up and then it will take a break, a little bit of retracement, reset, and then the next wave of upward move will happen. Well, if you're someone that doesn't understand how the market works, as we go up and you're all excited doing the money dance, but the money baby, right? And then we start retracing, you may panic, you may go crazy. Oh my gosh, this is the reversal, everything's gonna crash, blah, 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 blah. Especially as news outlets start picking things up and be like, oh, Dow Jones is down for the last 5 days in a row, right? Panic, trader, panic. And you start believing all that stuff, right? That's another manipulation thing that we'll save for another podcast episode. But the fact is, you may exit a position right as it starts to rally, as you flip on your charts the next week, and you miss a whole bunch of profit. So understanding that, hey, this is just a pullback. The integrity of the trend has not been violated, right? There's nothing to be fearful of, allows you to stay in that trade and be involved in the next wave up, which makes you more money. Vice versa, as traders and investors, we don't necessarily want to buy at the high. So I told you about my trading origins when I started trading in 2007, 2008, 2009, and I was able to catch a lot of stock prices on discount. We did the same thing in COVID, right? We had all this historical data of what the market should be valued at. COVID came and, bad stuff happened and the markets crashed. And we were able to judge where price action came to and judge some very cheap points to buy it up. And boy, did we buy them up. Crashes are bad unless you know how to deal with them. Then they are very, very good. It's like going into a store and everything says BOGO, buy one, get one. You're just, ooh, I'll take all of that, right? Speaking of which, I do shopping today and do that. My kids eat a lot of food. Anyway, but it gives you that knowledge of not panicking, saying like, hey, this is not the end of the world. This is just a little bit of correction, and I know that the next extension is soon to come. So it just allows us to increase our edge of understanding the markets, both from a technical perspective and a psychological perspective. Now, the next principle, number 3, piggybacks on the previous one, as it's more of a deeper dive into understanding the market. This is something that we typically talk about in many of our workshops. Ooh, by the way, we have a workshop coming up May 29th. Just head over to www.tier1trading.com if you want to learn about it and sign up. It's an online workshop. It's amazing. Check it out. But we spoke about trends and how the market ebbs and flows. I'm going to hop on the chart for a little bit here. This is a deeper understanding of what these different phases look like. And this is where kind of Dow theory, and I think Wyckoff kind of took it to the next level, allows you to understand the actual actions that are happening behind the moves. So to kind of make it as simple as possible and not turn this into a trading lesson in its own right, the market goes through three phases, right? We'll talk about it just from the bullish perspective, but if you want it from a bearish perspective, just take your camera and flip it over. Unless it auto flips back, then you're screwed. I don't know what to tell you at that point. I could record the whole thing upside down, but no, I'm not going to do that for you. Anyway, the market starts off in a phase of accumulation. This is like when the buying starts to happen. In real life, this is like a lot of the smart money institutional traders. They start their buying habits. They're very sneaky with how they do it. You don't necessarily see the market explode too much. It's kind of like, probe, like imagine a volcano before it erupts. Everything's happening below the surface, which is making the lava increase, but it hasn't yet erupted. Your second phase per Dow theory is going to be called public participation, right? So this is when the market shoots up. This is when you typically start seeing your retail investors get involved. So if you think about the first phase, accumulation, as being like your smart traders, your smart money, the people who are in the know about the stuff. The second phase, this is when the public gets involved. So we're doing all this cool stuff, it's happening, and then like the public hears about it, ooh, for real? And then everyone starts rushing for it. And that's when you see these big trending moves. This is an Elliott wave theory thing too, but again, I'm going to try to focus, so this isn't a whole hour-long training lesson. But that big extension, that's going to be your markup if you're a Wyckoff person. It's going to be your public participation if you're a Dow theory. And then after that is going to be called your exhaustion. Again, that's what I call it from Wyckoff. I'm trying to remember what Dow called it. I think he called it your excess phase. Anyway, this is where the buying starts to slow down, right? So price has moved from blank level. It's shot up a lot. A lot of people are making money. And then all of a sudden, two things are happening, right? When we go back to supply and demand, the price has gotten so high that not as many people are interested, right? There's a good Trading Coach podcast episode called Supply and Demand for Dummies. You need to listen to that if you haven't done so already. It breaks it down in the most simplest Akil ways ever. But once price gets to a high enough level, you're like, I don't want to buy it anymore because it's too high. And you also have people that bought it very, very low saying, I think it's high enough. I'm going to cash out and take some profits. And essentially you see a loss of momentum. You start to see the market take a breath, and you start to see those pullbacks that we spoke about. And then eventually the price gets to a low enough level where it either repeats the cycle or some economic stuff has happened and we go into a bearish trend. But these are the three phases of the market. And these are important to understand because as retail traders specifically, we often think, and this is because the internet is spreading all this weird stuff about smart money concepts and this and that and blah, 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 blah. We think that we have to trade like smart money. And the fact of the matter is we don't. We, in my opinion, have a massive benefit over smart money, right? In that accumulation phase where I said smart money is secretly and sneakily accumulating their position, they have to do it that way because if they entered their full position at once, they would move the market against them and lose money. So they have to play this dumb little game of like probing, which is, not fun. As a retail trader, because our accounts are so small that it doesn't really matter, we can buy and sell whenever we want. So we have the freedom to kind of sneak in and sneak out. We are like the fly on the elephant's tail, where if an elephant moves, everyone knows an elephant can't really be sneaky, or it's very hard for an elephant to be sneaky. If we're a fly just hovering around its tail, then we can just kind of go in and go out with that elephant and no one really notices. And that's kind of our opinion. So, or kind of our job in the market. So instead of being like smart money, our job is to be able to identify that elephant, identify when smart money is doing the things that smart money does, and then hop on for that ride. And that ride typically begins in that second wave or the very beginning of that second wave of public participation. And then we let the rest of the traders kind of buy it up. Now, what happens and where a lot of retail traders get into trouble is at the excess phase, this exhaustion phase, right? The exhaustion phase is typically the time everyone hears about it, right? So all this accumulation happens, no one knows about it except for the smart people. The public participation phase, people kind of start to know about it at different level. Once it gets like the highest point, that's when you start hearing about it on the news. And my late and great investing mentor always said, Akil, by the time you hear about something on the news, The move is over. So, we used to, gold was one thing I remember back in the day where we were buying gold, and it got up to a certain point, and everyone on CNBC and Bloomberg and blah, blah, blah is like, you got to buy gold, all time highs, blah, 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 blah. And I was like, yeah, Mr. Frank, should we buy some more gold? He's like, no, we need to start selling our position. I'm like, that doesn't make sense. He's like, you'll see why. And boy, did I see why. And I'm glad we did. But by the time the public hears about it, and there's a whole buying and selling liquidity thing in there as well, it's already been made, right? Those who are in the know, the smart money and the smart retail traders have already made their profit. And when newer late traders are trying to get in, trying to catch that last big boost because they, all their friends made money and they didn't, everyone else is trying to get out, and they kind of hop on right at the top of that roller coaster and boom, and fall to the bottom. So it's important to know the different phases, once again, to keep us out of trouble. We don't want to be too early. We don't want to be too late. We want to be right in that Goldilocks zone in the middle where we can make as much money as possible without taking on any extra risk. Theory number 4, principle number 4, I forgot what I've been calling them, is indices must confirm each other. And I'm not going to spend a lot of time on this one. This is one of the ones that doesn't really relate as much now as it did to Dow's original kind of theory on it. But essentially it means that indices should be doing the same thing, right? If one index is doing good, all the other ones should be doing good as well. And if they are, that's a good sign for the economy. If one is doing well and, like, say 2 others are doing poor, then it's more of an anomaly. It's kind of like a false signal. So indices should be correlated. If everything is good, they should all be pointing in the same direction and doing good. I don't think we need to dig into that any more deeply. But this next one we can, and this next one involves volume. And the principle says volume must confirm trend. And we had a great example of that this morning in my live trading room where we were talking about breakouts and what is probably going to be a false breakout because the breakout came with lack of volume. If I remember the analogy that I gave, if we think of volume as being participants, big breakouts, big moves should be met with lots of volume. So if you see like a really big candle that is really steep and large, then there should be a lot of volume associated with that candle because it means a lot of people were buying it. So imagine like in the action movie where we're trying to break in the door because the bad guys are on the other side and like, hey, we got to get in this door, and then someone steps back and just boom, big kicks through the door, and the door flies like 1,000,000 feet in the air, right? That would be an example of a breakout on volume. You kick that door hard as boop, right, and it flies away. A breakout or a move that doesn't have volume associated with it, so that same kind of big-ish candle, maybe not as big, but on very, very low volume, there's something suspicious about that, and it's more likely to be a false breakout than not. So going back to the door analogy, that would be yours truly thinking he is an action hero, because I did a few deadlifts and squats the other day, trying to save lives by kicking the door open, and instead of kicking it and having it fly 1,000 feet in the air, taking out all the bad guys, my foot gets stuck through it, my leg's dangling halfway in it, and I'm weirdly standing there with like half a leg in the door looking like an idiot. Meanwhile, my partner comes up behind me and just turns a knob and opens it up because, of course, being the man I am, I never actually checked if it was unlocked in the first place. I just wanted to kick a door open. Sounds like a story from personal experience. I promise it's not. Yes. Anyway, this is helpful with what we spoke about earlier with accumulation, public participation, and exhaustion or excess, right? If we're getting that move from accumulation to the public participation, right, that public participation move, well, even in the accumulation part, to be honest with you, but again, that's a deeper dive that I don't want to get into. That public participation extension, that big move, should be met with volume. We want to see price move up, and we want to see that everyone's interested in price moving up because that's how supply and demand works. When there's a lot of demand for things, price shoots up high. Vice versa, right? If price is continuing to go higher at that excess phase, right? So right up in this area right here, for you guys staring at the chart, and we're seeing volume not be associated with it, that's probably a warning sign, once again, that, hey, either it's too late to get involved, let me keep my powder dry, or if I am involved, hey, it's time for me to get out and start taking some profits. Even looking at the trend as a whole, we can go back to kind of sorry about that, I had to move my chart around. The basics of how price action moves, where we have extensions and retracements and extensions and retracements. Extensions, again, talking about a bullish trend here, are the longer moves up. retracements are the smaller moves down, right? And it carries on this ebb and flow until we eventually shift the trend. Well, if we're looking at volume as being a clue that we can use to tell if the market is continuing that trend or starting to rotate, we could look at that with our extensions and retracements as well, right? These extensions should be associated with high volume because people are pushing it up. These retracements should be associated with lower volume because there's just less people involved. If all of a sudden we have those retracements starting to have really high volume, well, that may mean that, hey, this is not just a pullback. There might be a lot of sellers, bears, looking to get involved in this move for, again, whatever reason. And this may end up being a rotation in trend. So again, small little clues from many different places. That is what makes trading difficult, but also very easy if you know how to look for them. And when I say easy, let's see, I take that back. Not easy. Simple. Not easy by any means. This is not easy money by any means. It is simple, but doing it is actually very hard. And that's why 90% of traders lose 90% of their money in the first 90 days. And I would honestly think that that number is probably a little bit low. All right, finally, number 6. I hope I got all 6 of them. I can't remember if I skipped over one or not. Sorry, but hopefully we're on number 6. And this is that trends will remain trends until trends are no longer trends. I think the actual verbiage is like, it's been a while. Trends shall persist until violated. Let me just do a quick search on that real quick. Trends persist until a clear reversal occurs. And this pretty much means that the market is in trend until it's not in trend. Boom. So it goes back to understanding the other principle. This is one of the reasons over at Tier 1 Trading, when we do our education, we have very strict rules for defining a trend. It's one of the hardest things to do is understand and ID a trend. It's even harder when you actually look at a price chart and you see how much price actually moves and wiggles, because it's like, oh, is this the pullback or is this a violation? So we've put together very strict rules that say, hey, we need these 3 things to happen to have an established trend. And that trend, no matter, that trend is intact until this very specific level is violated. So if the market is dancing around during a pullback, maybe it pulls back a little bit for, a few days, maybe it goes into consolidation for a few more days. Sometimes we're likely to think that, hey, the trend is over because we haven't moved up. The honest truth is that, again, the trend is still intact until it has been violated. And no matter what noise is happening within that area, until we violate it, or unless we violate it a very specific point, then that main trend is still intact and we must treat the markets as such. So I hope that was helpful. If you're interested in learning more about the markets, like I mentioned earlier, we do have a workshop coming up on May 29th. Head over to www.tier1trading.com. You can register and check it out. Also, take the 14-day trial membership on our platform. Lessons, live sessions, great community, 14 days, risk-free, no auto bill, no sneaky stuff. Just get on and surround yourself with like-minded individuals if you're serious about becoming an independent, consistently profitable trader. Thank you for checking out the podcast. Rate, review, like, subscribe, do all the stuff you're supposed to do. And until next time, plan to trade, trade your plan. Akil, out.